The live price for Plug Power Inc. NASDAQ PLUG is currently $2.67, reflecting an intraday movement of plus 6.37% as of the last available data point in today's session, which is a significant bounce after a mixed reaction to the recent earnings report. Now, the common expectation for Plug Power is a simple narrative. It's a volatile, speculative stock, a pure play on the future of green hydrogen that consistently burns cash while the dream of a hydrogen infrastructure slowly builds. Investors generally view it as a high-risk gamble on a distant future. The immediate surprise, the unexpected twist in this narrative, is the substantial positive swing in the stock price today, despite the third-quarter earnings report, released just a day ago, being a genuinely mixed bag with a modest EPS beat masking a revenue miss. The market usually punishes a revenue miss in growth stocks severely. The fact that the stock is up significantly today suggests that a deeper, more fundamental shift is taking place in how the street is valuing the company, moving past the headline numbers to focus intensely on one core operational metric, electrolyzer sales momentum, and critically, a massive, non-dilutive liquidity boost that was just announced. This is the tension. The reality of widening gap losses is being offset by a genuine, tangible sign of strategic execution and a substantial improvement in the near-term cash position. The general belief among retail investors, particularly those self-investing through platforms like Robinhood or engaging with online investing communities, is that Plug Power is perpetually flirting with a cash crunch, constantly relying on dilutive equity raises to keep the lights on while the hydrogen economy matures. They see the negative free cash flow, the continuing gross losses, and the need for regular capital raises, which understandably creates anxiety. They look at the daily swings, the high trading volume of nearly 190 million shares recently, and see a battleground stock. Our deeper take, the reality that warrants attention, is that the latest earnings report offered two specific data points that fundamentally challenge that anxiety and force a rethink. First, the Generate Electrolyzer revenue surged by an impressive plus 46% sequentially. This isn't just a marginal bump, it's tangible evidence of increasing commercial traction for the company's core technology, the equipment used to produce green hydrogen, which is the most valuable and least commoditized part of its business model. Second, and perhaps more impactful for the stock's immediate survival story, is the news of a new plan to generate over $275 million in liquidity improvement through a combination of asset monetization, specifically electricity rights in New York, a release of restricted cash, and reduced maintenance expenses. This is money coming in without issuing new shares, which is a direct positive hit to the long-standing dilution fear. For a company valued by its potential future cash flow, solving the immediate and perennial cash burn problem is often a bigger catalyst than a quarter-point beat on an adjusted earnings per share number. This strategic maneuvering is the real story, driving the recent positive movement, overriding the gap noise, including the $226 million in charges, primarily related to the internal Project Quantum Leap, which is management's effort to clean up the balance sheet, streamline operations, and ultimately focus on profitability. Looking closely at the recent stock movement, the Plug stock has been highly volatile, reflecting the market's internal debate over its long-term viability versus its immediate financial risks. Following the mixed earnings, which showed an adjusted EPS loss of minus 12 cents that beat the minus 13 cents consensus, but revenue of $177 million that missed the $187.33 million forecast, The stock initially traded sideways to down, but the subsequent trading session saw the strong push up, suggesting a delayed but strong institutional reaction to the details, not just the headlines. High trading volumes currently at elevated levels compared to the 90-day average indicate strong institutional engagement and short covering activity. The institutional holding data from recent filings shows a complex picture. While some large institutions like Norge Bank and UBS Group AG dramatically reduced their positions in a prior quarter, other firms like HRT Financial LP and D.E. Shaw & Co. Inc. were aggressive buyers, which underscores the polarization of the stock. It's not a consensus buy or sell at a large scale, but rather a sharp disagreement between those who are cutting losses and those who are betting on the turnaround strategy. This back and forth between major institutional holders contributes significantly to the stock's remarkable daily swings, which retail investors who use individual brokerage accounts from companies like Fidelity or even the fractional shares functionality on platforms like Robinhood need to be aware of. The technical setup, which saw the stock gap up recently, indicates that the short-term momentum is now positive, driven by the perceived improvement in the liquidity risk profile. Now, let's briefly step back to understand the foundational business of Plug Power, which is often lost in the day-to-day trading noise. Plug Power is not simply a hydrogen fuel cell company anymore. It is striving to be a vertically integrated green hydrogen solutions provider. The core of its business is building the entire ecosystem, designing and manufacturing proton exchange membrane fuel cells, GenDrive for material handling, GenSer for stationary power, building and selling the electrolyzer stacks, GenEcoa for hydrogen production, and establishing a network for producing and delivering the green hydrogen fuel itself. Its key end market has historically been the material handling sector. Think forklifts in massive distribution centers for major companies like Amazon and Walmart. The belief is that hydrogen fuel cells offer a more efficient and less time-consuming refueling solution than large batteries, which is a critical operational advantage for high-volume logistics. However, the future is really pinned on the electrolyzer segment and the build-out of a continental hydrogen production network. The company is in a massive capital expenditure phase, building out a number of green hydrogen production plants across the United States. This is a capital-intensive, low-margin business right now, which is why the financials are currently so painful. The business model is a land grab. Build the infrastructure first, lock in customers, and then profit from recurring fuel and service agreements over the long term. This strategy necessitates a high cash burn, which is the root cause of the tension between the expectation of cash flow problems and the long-term potential. The future outlook for Plug Power stock is entirely a function of execution and government policy. The expectation is that the company will continue to struggle with profitability and remain dependent on external funding until the hydrogen fuel production plants are fully operational and cost-effective. The reality that the current price movement suggests is that key milestones are being hit faster and more efficiently than anticipated, particularly in the electrolyzer segment and the proactive management of the balance sheet through non-dilutive means. The most important catalyst going forward is the implementation and finalization of the U.S. government's 45V Clean Hydrogen Production Tax Credit, a massive incentive that could dramatically lower the cost of green hydrogen and make Plug Power's fuel business economically viable much sooner. Delays or unfavorable structuring of this credit remain the biggest systematic risk. If the 45V credit is favorable, the economic viability of their new production plants changes overnight, making their long-term fuel contracts profitable. On the operational side, the succession plan with the naming of a new incoming CEO, Jose Luis Crespo, succeeding long-term leader Andy Marsh, signals a planned transition from an R&D and scaling up culture to one focused on disciplined execution and commercialization. This is a subtle yet powerful signal to the market that the company is maturing. For investors using sophisticated trading platforms like Interactive Brokers Trading Platform or those who manage their own retirement assets through Fidelity IRAs, the risk-reward proposition here is stark. A bet on Plug is a bet that the company can bridge the financing gap to the second half of 2026, when management expects to achieve an EBITDA positive performance. The ability to pull in non-dilutive cash flow now, coupled with the strong sequential growth in the electrolyzer business, significantly increases the probability of bridging that gap. The recent news of securing over $275 million in liquidity is a huge psychological and financial buffer. The risk, of course, is that the large non-cash charges